are on. Hey, good early afternoon, everybody. In Texas, it's 11, so late morning. In the East Coast, it's noon. Happy lunchtime. Welcome to our mortgage updates with Hammer. We are going to dive into a couple updates. I've always liked the Japanese candlestick charts. I don't like what they're doing lately, but I like talking about those. Hammer, you've got a couple slides, and then I've got a couple questions that we're gonna follow up on from a live we did last night in VetaVA, our first VetaVA live on Tuesday night. So, what do you got for
Awesome.
us today, Hammer?
Fantastic. Do me a favor, throw the screen up. Let's go ahead and
I'm
let's
ready.
just give everybody a quick recap of what's going on in the world today. So, welcome to our rate conversation. It's April 6th. Let's go ahead and bounce into. So, basically, the forecast for this week, we did a quick recap of what happened last week. Rates actually improved a little bit last week, more so towards the end of the week. And that was mainly because when it rains for as long as it has, you got to get a sunny day once in a while. Average mortgage rates last week actually improved just a little bit. And what anybody that was locking in loans may not have seen rates themselves actually improve all that much, but you may have seen a little bit of better what we call rebate pricing. Rebate pricing is the credit that a lender can give you towards your closing costs, or maybe that you were able to pick up a little bit of a better interest rate and not have to pay for that rate, or maybe not have to pay as much for that rate in what we call
Mm-hmm.
points. But as far as this week, there was a lot of volatility, and boy, has it proven out. Remember, I wrote this on Monday, and we've already seen it already. So
Yep.
mortgage rates not likely to improve much from here. We could see rates worsen on Wednesday when the minutes are released from last month's Fed meeting. So we're going to talk about that today, talk about what the Fed meeting minutes are and why they're important this week, and what happened yesterday that actually was kind of a sneak peek to the party. And we saw rates get worse yesterday. And that was
Mm-hmm.
actually because of what we expected to see in the Fed meeting minutes today. Markets looking for signals from the Fed on how they'll be reducing their balance sheet. And I'll explain what that is and why. We'll, kind of oversimplify that today. But really, that's what's affecting markets the most. There's really no other economic data to worry about this week. In other words, sometimes we look at jobs data or inflation data, really not
Mm-hmm.
anything this week to worry about, no reports. Russia and Ukraine, still, of course, very important, very prominent in the world, having a minimal effect on mortgage rates right now, though. And everything is really about what's going on with the Fed. So what does that mean? What is our rate outlook? So this week, rates have moved higher after the Fed members came out saying the Fed would need to raise rates aggressively and that they would need to reduce their balance sheet holdings as soon as the May meeting. And again, I'll go into a little more detail on what I mean by that in a moment. But for this week, it's not looking good for rates to get better for sure. In fact, they've already gotten worse. The next couple of weeks, rates are not likely to go down much or at all from here. I'm hoping they won't go up too much, but they could. And we'll see as we get between now and May 4th, which is when the Fed has their meeting. We're going to get another, inflation report, but that we hopefully won't see rates move up too much between the next couple of weeks, but it's very, very unlikely that they're going to get better. So keep that in mind for anybody that's holding out hope that that's going to happen. And the last thing is 30 days plus rates are more likely to be the same or higher than they are to improve. We said that last week, and that's exactly what it's looking to play out as and how it'll continue to play out. However, the good news is for all of you that are buying homes this year, as rates have gone higher, we may indeed see a recession in 2023. And the reason we're forecasting that things are going to slow down in the economy in 2023 is because of what's happening with the Fed now, and some of the indications like the inverse yield curve between a 10 and 2-year Treasury note and bill. So those are some crazy little things going on, but we could see the economy slow down and rates could get better in 2023. And for those of you buying a house now, there's a friend of mine I want you to meet. His name is Earl. And Earl, what is Nathan? What is an Earl? Tell everybody about Earl.
The interest rate reduction refinance loan.
Absolutely.
Was that it? I don't know. Am
Yeah,
I supposed to
that
tell
was
them
your
more?
intro. I do all the talking. I wanted to bring you into the conversation. That was my softball. Like, tell everybody about the Earl and why 2023, if things get better,
Oh,
why they care.
oh, I'm so glad you said that. I apologize. I got sidetracked because I was looking at a pending post. I was like, oh, we need to talk about this. But so the Earl, when you're purchasing with a VA loan and the interest rates have risen, right? And you're like, oh, okay, this is terrible. We don't like this. This doesn't feel good. There are only a couple loan products which actually provide you an amazing opportunity to reduce that interest rate in the future quickly, efficiently, and at low cost. And the VA is the leader in all of that. The interest rate reduction refinance loan, the IRRL, IRRRL, really allows you to go in and say, we own this home. I'm currently in this home. And if you've had to move away and maintained your VA loan on that home and have somebody renting it, you still get to use it because it's a VA held property. And you get to say, I need to refinance that to drop the interest rate. Now, the rate has to fall by 50 bips or a half an inch, half a point, or lower, right? So there has to be a benefit to you, the veteran, before they'll actually approve it. But the underwriting process is fast, it's efficient. It usually does not require an appraisal because you're not actually taking out more money or changing the greater terms of the loan other than maybe resetting the payment structure. You don't get cash out of this, but you can put your closing costs into it. And yeah, it's a fantastic. So if rates
Yeah.
are going like this right now, and then we hit recession type activities or whatever, things start coming down and the mortgage rates come back down, I don't have to really fret if I can afford what I'm buying right now. And in the future, those rates come down. I just call the loan officer up again real quick and go, hey, I see rates or I heard something. Tag me. Like, can we do an Earl? Let's move.
That's it. So everybody keep that in mind. With rates going up, you're not stuck in this forever. If rates go back down, now is still the best time to buy because prices are still going to go up. And that's what actually leads me to the next slide. So, Nathan, I am seeing a lot of posts on Vetted VA and in the group about the housing market being in a bubble and
Hmm.
people being concerned about buying right now, and with mortgage rates going up and with home prices going up, and they say prices have to come down. And normally I would agree. I would say, for years I've said it's a seesaw. You've got a fulcrum in the
Yep.
middle, and when rates go up, prices come down, and when rates go down, prices go up. The problem is the fulcrum is broken because that
Yep.
fulcrum is affordability, and that's really what's changed. So all of y'all that are looking for, a housing market that is in a bubble, one thing I'm going to say is be careful. This group, Facebook, social media as a whole, but this group especially, is a great resource. But always just be careful who you're listening to. Are you listening to one of the moderators, maybe that are really educated and trained in the housing market? Be careful that you're not listening to other people that
Hmm.
may not necessarily, not that they don't know what they're talking about, that sounds kind of mean, but they may not have any factual foundation for their belief. Like Jennifer Howard said, I honestly have given up for now until the housing bubble bursts. And that's because it's so hard to find a home right now. You want that bubble to come, you want it to be a bubble, you want it to burst. But there's a couple of reasons why it's not a bubble right now, and I'm going to give you
Hmm.
guys that factual information. So
Go.
home prices are being driven up with bidding wars. And these are posts just in the last 22 hours, in the last one day, that are current on the group. I pulled them 5 minutes before this call today, from people in the group. Can someone give us advice on how to beat these high rollers? We've been beaten 6 times by buyers offering higher than 30,000 over asking price. Fifth offer was declined this morning. We went against a 30,000 over on asking. It didn't get accepted. We went 30,000 over on asking and it didn't get accepted. So, this is what's going on, is all these bidding wars driving these prices up. Housing supply remains extremely limited, and it's going to remain extremely limited. We can't build houses fast enough. We've talked about that on past calls. The
Hmm.
home buyers are more credit worthy. That is another issue that's totally different than back when we did
Yep.
have a true housing bubble back in 2008. The people that are getting loans today are getting loans because they qualify. There's more cash offers out there. So that we're not going to see what caused the 2008 breakdown in the housing market. We're not seeing that play out again. This is a very different set of circumstances. And the last piece, homeowners have equity. And in 2008, many homeowners were just pulling equity out as fast as they could. And then when the home prices started to drop, it became a much, basically it was an avalanche. It just got worse and worse, and home equity dropped. We're not
Hmm.
seeing that this time around, not with these kinds of situations where, again, there's just such a strong demand despite increased interest rates. that we're not seeing that drop in home prices. So just keep that in mind. Now is still a fantastic time to be buying a home.
Yep.
It's very unlikely that you're going to see a pullback in home prices. If you did, it would only be for a short period of time, 2 to 3 years before we saw it recover. And that
Right.
would be the expectation. And that's believed across the board. So don't find yourself in a situation where you're not getting in and you're sitting on the sidelines because you're afraid of these home prices. They
Yep.
they suck. They don't get me wrong. When every I would love to have bought 10 houses in 2012 or 2013 when prices were literally half of what they are right now, but
Hmm.
unfortunately we couldn't. So you're always stuck with what do I have today? And this is with all of our products that we're buying. I bought some things that aren't homes. Recently bought a trailer so I could pull my
Hmm.
motorcycle. I bought an attachment for my tractor. I stopped in a couple months ago. They're like, oh yeah, set of forks, $750. I stopped in a couple weeks ago with the truck to pick them up, and they're like, yeah, that'll be 1,000. And I went, whoa, what happened to 750?
Yeah.
And nobody likes to pay more, but still a good time to buy a home. So anyway, that's it for my spiel today, Nathan. What is it that you wanted to talk about, and where do we go from here?
Well, you actually hit on one of them, and that's the hope conundrum, right? It's hopeless. I keep getting denied. I don't know what I'm supposed to do. And what you need to do right now is there's so many things to focus on when you're buying a house. There's interest rates, there's timeline, there's cash to close, there's what do I need here, what do I need there, where am I going to move, what does it look like over here. One of the main things you need to do is work with someone you can come to trust, right? And when you ask them
Mhm.
a question, you're not getting a, oh yeah, it's fine, like I'll just do this, but you're actually getting some resolution, you're getting some education through the process. Interest rates as they go up, right? You were talking about the Fed change. You're talking about bank rates that has an impact to the market. The market will respond. Interest rates and mortgages are seeing increases, and we've talked about those in previous videos. Last night we talked about shopping. Shopping right now in this industry, when you have a loan estimate, unless that thing is locked in, you don't really have anything in your hand that's going to prove to you what that loan is going to cost you. To get a locked loan estimate, most lenders are going to require six things as called up by by TRID, or the Truth in Lending Act, or RESPA, Integrated Disclosure Act. Um, and that those six things, right? Name, social, amount you're going to borrow, the value of the property, address of the property, birthday, I believe is
Yeah.
birthday. So the six things. And those six things, then they're gonna say, I have a full application. I need to give you a loan estimate if it's locked or not is the question. Because a non-locked loan estimate means they're just, okay, that's the interest rate we're gonna go with right now. And if the market changes the next 4 hours and there's a movement, that will adjust the fees, or the structure of the loan a little bit. And to some degree, if you're tight on DTI right then, that could adjust what you're gonna do. Here's how you're going to win in a scenario like this. Here's how you're going to win in a market that is so exceptionally competitive and we don't see a bubble bursting anytime soon. Number one, go get yourself pre-qualified at the highest interest rate you can qualify for. So you know what your ceiling is, and you know what that feels like, and you know what that looks like. And if your pre-qualification is, well, we can't really take you above like where it's at right now, now may not be the right time to buy. Then your next question is, how do I get prepared to do a little bit more? How can I afford a little bit more? What does that look like? And have that conversation with your professional. The second thing
Or
is understand,
or
yeah,
adjust
go
your
ahead.
expectation. Sorry, yeah, or adjust your expectation. Which I've noticed some of the posts in there. A lot of people say maybe I need to assess what I'm buying. We want a 4 bedroom, 5 bedroom, 3 bathroom, move in ready type home, and yet
Yeah.
you may end up getting a 3 bedroom, or you have to assess what your buying power is at that point.
And that was my second point. It's take a step back and relook at what you're going for, right? If you want this, but you can only get this, where are you in the buying life cycle? My first home was not my last home. I'm in my third home now, and it's probably not going to be my last home either. I don't know. I'm fixing it up. It wasn't exactly what we wanted, but we got the space we needed. So think about those things and then think about the location. And do not give up. If you decide to just stay and renting is the right thing for you right now, that's a decision you're making. But understand that rent prices will not maintain where they are. Leases will adjust, because if for no other reason, the market values around the landlords are increasing. You may have a fantastic landlord who loves you very much. but their market prices are increasing around them, which means that the set and legislated um, property tax that they're paying on that property is going to adjust on
Going
them.
up.
They cannot stop that. The market level of prices going up means that there becomes historical data. The tax assessors look at that data and they say, hey, the market's doing this. Hey, the market's doing this. Okay, well, we now value your house here because of all these sales that are happening that raise the price. That has to be a cost that's going to be passed on to the renter. So if you're not buying right now, buckle down. You're going to be okay. But do not give up and start saving more money because your rent is going to go up as soon as your lease renegotiates or your lease expires that you're currently in. The market is not, the cost of the market right now is not being driven by real estate agents. It's not being driven by greedy sellers. It's not being driven by, um, it's really actually, I'm going to say this and I don't have a lot of factual on this. I don't think it's even driven by cash offer buyers or the BlackRocks of the world. The market's being driven by one of the age old economic truths, supply and demand. Go look at the the federal economic data, right? And there are just too many people who are ready to buy a home that have waited and waited. And we're just like you said, the fulcrum's broken, and you're absolutely right. That fulcrum got crushed by demand and the
Yeah.
lack of supply. There just isn't enough out there to build on.
Well, and it was one thing you don't see anybody talk about, right? Baby boomers were the biggest generation for a long time. Millennials are the largest generation group since 2019, an estimated population of 72 million. And the millennials were all born between 81 and 96. They're all buying homes now. This is, it's a huge demand. And you have some of the early Gen Z that is even starting to get into buying homes, 23, 24-year-olds, 25-year-olds. That's Gen Z. So
Hmm.
millennials are right in the thick of it. And it's supply and demand. Plus, you have more people aging at home. You have less homes that are getting on the market. There's an argument that people that have gotten a very low interest rate are going to keep the homes that they're in, maybe do renovations because they don't see the value to taking a higher mortgage for a different home and they may not move out of that home. So that could affect the supply. And, again, it's frustrating. It's hard to buy a home today. It really is
Hmm.
because you have to protect yourself emotionally and all of these. It's funny. Nathan, I was watching HGTV with my wife this past weekend, and I generally watch it when I'm away on trips. And I was visiting my
Sure.
sister and her family in Pittsburgh, and we're at the hotel. And that's usually when I watch HGTV is when we're in a hotel. And this was the first time in a few months you could tell the shows are newer because they
Hmm.
actually had people that were house hunting, and the real estate agents in the shows were saying, hey, listen, this one went on the market this morning and it'll be gone this afternoon. You can't sit and
Hmm.
compare these three houses for 5 days and poolside talk about what was going on, and they're like, you may need to come to terms that you're not going to get those extra bedrooms and you may need this extra, and again, it's and I'm not saying to anybody that you shouldn't be trying to get what you want. I understand, but at the
Yeah,
same point,
absolutely.
I remember sharing a room with my brother, and nowadays it's like, sometimes we want to have a space for an office and a space for a guest room and a room for each of the kids. And well, maybe you're not going to get those things, and we need to just go back to the idea of a smaller home or a starter home or a sharing a room, just to get on that equity train, because I can
Yeah,
tell everybody that's watching, you
that's the
want to
key.
own a home right now so that it's building equity for you. You want to get in the game, get off
That's
the
the key.
sidelines, don't be
Hmm.
renting. When you're renting, you're building equity for your landlord, and that's a necessary thing. And sometimes there's great situations to be renting,
Hmm.
but you want to be building equity, even if it's not the home of your dreams. At least this could help you to get that first step. You've talked before about, you said this is your third home. And
Hmm.
I remember my first condo was certainly not the home of my dreams. I bought that for 90,000 back in 2000, and it helped me to get into my house. It built equity for me, which then 2 years later helped me get into a bigger home. My, 4 bedroom, 3 bathroom, center hall colonial, and that helped me get into that. So
Yep. Well, I'd say there you hit it on the get in the game. there's a couple things, right, that line up here. Actually, I'm in my bedroom. I That is my office. I just twisted my desk around so I'd have a bookcase behind me. Um, that is something you do to get there, because stalling now and just saying, well, we're not getting what we want. We've put all these offers in. We keep getting beat out. Okay, adjust, reassess. I think we're talking to a marketplace. The veterans, the active duty, the spouses, man, they've lived in some pretty bad places. I bet almost all of them have some stories that would would make me go, ugh, that sounds terrible. So I know they can do it, and I know that there is a. I'm tired of that, but here's where the problem. Here's the thing. It's not a problem. It's an opportunity. When you can jump into, invest in your community, invest in an area, you are part of the solution for the future of that area as well. So if you buy into something, how you maintain that really changes things for the community. There's a sense of pride when you build a neighborhood like that. And so I think it's really beautiful when you take a step back and go, well, it's not what I really want, but it's what we can do right now. And you jump in and it becomes yours, and you paint the walls. And you know what? Honestly, here's a personal story. Last night, the kids' toilet, we've got a two-bathroom house, and the kids' toilet started leaking from underneath. Do you know why I know what that is and why I didn't freak out to go call a plumber? Because I've had my first house and I changed a couple toilets, and I understand what a wax ring is, and
Yeah.
it's a what, $5 part now, and I went and picked up a good one, and I'm like, all right, I'm gonna have to go scrape that wax ring out and reset
Did
the
you go to the
toilet.
plat? Did you go to the rubber ones? Oh, the rubber ones are so much easier. Did you go
I
wax
know
ring
they are.
again?
I went wax ring again because
Ah,
I needed the height. I needed the height on it. It's
all
the
right.
offset anyway. See, you'll know this once you buy your first house and you have that
Yeah.
toilet thing. And you're like, what do
Oh
I
yeah.
do? And you YouTube it, and it's amazing. I promise you this: keep fighting for it. Keep driving for it. Do not give up in this market. Do not blame the real estate agents for the rising prices. Do not say that sellers are being super jealous. That's not what's happening here, or super
Super
greedy.
greedy. Yeah.
What's happening here is a market has massive demand that we've never seen before. We have a market, and I was looking at a Housing Wire article that has a lot of good economic data on here. We have a market where home starts dived. The costs are keeping them low, not the demand. We know the demand's there. If the builders could get all the materials they wanted, you would see it going gangbusters
Yeah.
everywhere. The demand of the
Materials,
marketplace,
labor,
the
the
material,
regulation. People
everything's
don't want
holding it
to
up.
build. Yeah.
And it's not going to be a fast response, which means the demand stays going. And even if we stall, like you and I recovered from the recession. I bought in 2006, and then my house price went like this, and by
Yeah.
2011 or 12 it was kind of back up to where I purchased, and it took a while, but we got through it. So hang in there, everybody. You're going to be okay, and let's keep fighting. If this should not be a negative when you hear market house prices or interest rates are going up, the best thing that may happen is that prices are going to stabilize and slow down a little bit, because as the interest rate goes up, the affordability, right, that structure has to still balance, and it seems it's not a perfect mathematical equation where it must be balanced, but it fights for balance, and so you're going to find balance, and it's something to keep pushing forward on.
Yeah. And
Cool.
and Nathan, correct me if it's not the philosophy of vetted VA, but I know there's a lot of really solid professionals that are vetted VA
Hmm.
professionals. One thing I would say is for those potential home buyers out there, for y'all that are looking, that factor that in, as well as interest rates and everything else when you look at who you're going to work with, because working with local professionals and vetted VA professionals, they may be able to help you to get your offers accepted by,
Hmm.
providing a stronger pre-approval and a strong, reaching out to the different agents, and versus some of the bigger canned places. Again, without overstepping, I'm not a big fan of the canned places. And,
Right.
for that reason, and they can help you, work with your team. It's a different home buying process. And you just want to think of it that way. Think of this as your team. And again, I was never in the military, so I don't want to sound like a goof, but as your unit, if you will, but whatever you want to think of them, this is your team, the agent, the loan originator, loan officer, mortgage person, and they can help you to get into these homes and lobby for you and kind of try to get your offer to the front of that pile. Sometimes there's a negative connotation about VA loans, and yet they're one of the best loans out there. Having the professionals that can point that out to the other side and the sellers,
Yep.
sometimes that's a value. So keep that in mind too. Use every available resource to get
your
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 offer accepted.
team your team should be working with you. Your real estate agent, your loan officer should have the ability. We have a lot of our VA loan officers talk about and tell others, like, call the listing agent when the offer's going in. Make the phone call. Hey, I understand you're getting an
Mhm.
offer from my client. Here's why it's a good deal. Here's how we're prepared. Here's how we are lined up, ready to rock and roll. Like, we're gonna get this all the way through. So push through, and you're going to be good. I think the other part that you lean on, that somebody posted, and we can't approve this post in vetted VA. A pending post, which was ultimately declined, was, here's my interest rate, here's the loan amount I'm trying to buy, is this a good deal? I can't
Okay.
answer that. We can't answer that for you because there's not enough data, there's not enough detail in that post for us to really help you understand, like, what a good deal is. In fact, it was like, um, oh, it's an interest rate with points.
Right.
I can't tell you that because I don't know your financial situation. I don't know the market you're in. I don't know.
When
While
that
I could
when
look
that
at it
rate was quoted, or when it was, when you're
exactly,
comparing
I
it
don't
to.
know what FICO score you're
Yeah.
at. I don't know what your DTI is. I don't know how soon you're looking to do this. So, so here's what I would say. I'm going to tag this person in the video about points. When you are offered a rate with points, there's a calculation you must do. When do I get my money back by buying down that interest rate? I'm gonna tag everybody on that video for this one. But when you're looking at it, just do your math, come back, trust and verify, ask the questions. And what we want to do at VetVA is give you more information so you can go be your own best advocate with whomever you choose to work with. And yeah, we'll be there
Yeah.
for you. So,
When it comes to points, the question is, this is probably one of the stickiest times to talk about points, because if we
mhm,
do believe that the economy is going to slow down in 2023, and that you may do that Earl we talked about to kind of bring us back to the beginning of the video today, that's when paying points would not pay off, because you're not going to be in the loan long enough to get the benefit of that. However,
exactly.
if you think that, again, interest rates at 5 or 4.5%, 5%, 5.5, these are still interest rates that, you may say, hey, I'm going to be in this one for quite a few years, and the math does make sense. So it is a tough one. Points are very, very subjective right now. There's times where it would have made a lot of sense if
Hmm.
rates were in the low threes and you were paying points to get into the twos. The likelihood of that being the lowest interest rates we were going to see for a long time was much higher than necessarily what we're seeing today. We don't know what 6 months or a year could bring, and it makes it more subjective. So factor that into your decision. If
Yep.
rates do drop, are you willing to write that money off, or are those points going to make it more affordable, or are you better off just keeping that money in your pocket and paying it towards your principal later?
Because the toilet's going to break. So I'm just going
Yeah.
to say, like, you got to
Yeah.
have some way, some way to cover the costs of what you're about to get into. So, all right, I think we had some real talk there. It was both hopeful and real. So if you left this conversation feeling discouraged, that was not the goal. The goal is to be like, here's what we're dealing with. We're not going to
Yeah.
sugarcoat it for you, but there is good things coming, because there's still hope. We're still moving forward, still growing, and this is going to be a pretty killer market. So hang tight, everybody. Thank you, Hammer. As always, I appreciate seeing you every
Yep.
week, and
Thanks, Nathan.
see you next week.
Take care, everybody.